last chapter of this course, which is chapter 13. It is a short chapter, but we are almost within kissing distance of 8 o'clock. Would you guys like to take a bit of a breather, or do you want me to keep going? Personally, I would appreciate maybe a short break. Been talking for long. Yeah, short break. Okay. So can we come back at say about five-ish, 5 after 8 kind of thing? A little bit maybe after that, but not too long. We won't need as much time. This chapter 12 was the longer of the two. I don't have as much for the political issues. So we should still be done by around, I'm thinking about 8:35, 8:40, something like that. It's like last Friday. All right, so I'm going to pause the recording here and I will be back in a couple minutes. All right, good people. After this short break, let's move on to chapter 13, standard setting, the political issues. We're going to look at two competing theories from, this is from the political analysis, so not economic based theories, but two theories of regulation. And then we'll see how uh, in the midst of conflict, how do we achieve compromise and get the accounting standards that then everybody agrees to comply with? We'll, by way of an example, consider regulation fair disclosure. We will summarize what the criteria are for a standard to be successful, and then wrap things up with how the integration of capital markets internationally is affecting accounting. So the two theories of regulation. On the one hand, we have the public interest theory. And on the other side, we've got the interest group theory. Now, the public interest theory basically takes the most charitable view of human nature, and they say that the regulators, the people who are entrusted the task of coming up with reporting standards, they try to do their best to protect and uphold the interests of society. Regulation seeks to minimize the costs that society has to bear while maximizing the benefits to society of it. Now, it sounds very noble. The problem is that sometimes when you try to implement it, it's kind of like implementing the concept of socialism, communism. In principle, no one should own productive resources. Those resources belong to society. The people own the resources. Everyone should share. So it's almost like living on a commune, right? Everybody benefits and so on. But when you see the implementation, you have to just read Animal Farm to see how there will be some people who will end up being seen as more equal than others, and there are inevitably winners and losers in the process. The other big thing is that it's difficult to decide who decides. And if you see how socialism, communism actually played out, the Politburo and the planning commissions in countries like the Soviet Union, they sometimes made decisions that were horrendous, right? Because it is ultimately a bunch of people. People are fallible. They're also corruptible potentially. And that we're seeing that possibly in some parts, some pockets in China. You have the Communist Party, and although in principle, everything belongs to the people, there are some people who have the power, and they become corrupted. And the question is, you have the standard setters who are acting as the watchdog. Well, who's going to watch the watchdog? Right? There's an infinite regress. Where does the buck stop? So the public interest theory sounds very noble, but it does not really play out without any challenges. On the other hand, if you consider the interest group theory, it's a little more cynical. It says, hey, there are going to be people who will get affected. There are entities that will get affected by standards. And these are the people, the investors, managers, if you will, these are the ones who are going to lobby, right? And lobbying is trying to convince the standard setters and make arguments for what they would prefer the accounting standards to be, right? So if you look at how things work out in Canada, the you have the accounting standards board that has the power to set the accounting standards for Canada. Now, we assume that the people who serve on the accounting standards board, these individuals, because they are individuals, every individual has the right to be self-interested, right? As long as I don't infringe upon the liberties and the well-being of others, I should be permitted to pursue my own happiness, enhance my own happiness. That's sort of the American way, and that's similar to what we espouse to in Canada in general as well. So while balancing the demands of various constituencies, the regulatory body is assumed to maximize its own welfare. Now, the problem is that when we are lobbying, so then there are competing parties lobbying for the attention or clamoring for the attention. Um, it's almost like a parent with multiple, with multiple kids all asking for their attention at the same time. The kid that yells the loudest or whatever is the most disruptive will likely get attended to most, right? Or quicker. And that is what will happen. Inevitably, when we have competing parties, the party that is able to lobby the most strenuously will be the one that will end up getting what they want. So if we look at whether interest group theory can be applied to standard setting, amongst the predictions that will follow from interest group theory is that there will be a creation of a standard setting body. We see that happen. The reason why the standard setting body is set up is linked to the earlier chapter that uh, because the markets were not able to come up with a socially optimal amount of information, hence we needed standard setting. And then inevitably you'll find that there is, in order to give the appearance that the accounting standards or the reporting standards are not arbitrary or haphazard, we would predict there to be a due process, i.e., a process of consultation, debate, refinement, etc. And we see that's exactly what happens. That's exactly what happens in the way the accounting standards are set. So let's try and dig a little bit deeper. So if there's a new accounting standard being planned, there will be some opposition from managers who, rightly or wrongly, with substance or without, may be afraid about the change. Some of them might fear that there will be economic consequences. Remember, economic consequences differ from accounting consequences. So if there's a standard, a new lease standard that says all leases have to be reported on the balance sheet as a lease liability, along with a right of use asset. Now, when the new standard was proposed, there were at that point in time a lot of companies that may have bypassed the need to report a lease liability by structuring the lease in a way that they would only be able to um, they would be able to get away with reporting the lease as an operating lease, just a rental. Now, for those companies that would have to then now convert those operating leases into effectively finance leases, they were afraid, even though in terms of cash flow, the cash flow for the lease is the amount of lease payment that you're making. That wouldn't change, right? The classification of the lease will have no impact on the cash flow aspect. In theory, the users of financial information want to be able to assess cash flows. But since cash flows are harder to predict, users often look at net income numbers. Now, in capitalizing, requiring the leases to be recorded as capital leases, there's a couple of things that happened. A, the amount of liabilities recorded on the balance sheet grew. That has an impact on the debt to equity ratio. Debt to equity ratios are important covenants, right? They are very commonly used covenants as part of lending contracts. And covenants impose maximum limits, right? Maximum limits to debt to equity, beyond which there's a triggered violation, and that can result in either the lender asking for their money back or asking for the interest rate to go up, which are anyways bad outcomes for the company, right? So rightly or wrongly, these managers would have opposed the new standard. And if the preparers or a large number of preparers are against it, but the users they want, right? The users want to see the leases on the balance sheet. So you have two competing constituencies. Now that requires compromise, right? When you have differences in opinion, one party supports the standard, the other party opposes it, then you have to come with some kind of compromise. And that compromise requires a process of consultation, fine tuning, et cetera, et cetera. And there have been multiple examples, including IFRS 9, the standard on financial instruments, the standard that came up with other comprehensive income, and also regulation fair disclosure or full disclosure. So regulation FT as an example of compromise, it was adopted in the year 2000, many years ago, and the intention was to improve upon fairness of information distribution. Now, before this, companies used to selectively hold conference calls. They would invite certain specific individual analysts to attend the conference call. And the top management of the company would present the information to these analysts only, answer their questions only, and there might be some reporters in presence as well, and basically then allow them to pass on the news to their whoever the analysts were answerable to, or the newspaper reporters allowed them to report, but no one else got access to the conference call. And that led people to question, like, how come the analysts are getting access to the information and not the others? So there was a perception that the marketplace was not fair, and that was potentially affecting the liquidity of the market. So regulation FT was intended to improve upon those shortcomings. However, there was considerable conflict. The people that opposed the regulation said, hey, we might have more abnormal share returns, greater volatility between earnings announcement dates, or we might find companies just reduce the amount of information that they provide because they don't want the Um, they just don't want the headache of having to invite everyone, anyone and everyone who's interested. Now, the way the conference calls are done nowadays is that, you could have Zoom, or uh, for a while there used to be these call-in numbers, that anyone who's interested in the conference call could call at that number and then listen in. With technology, those costs are being driven down, but in the time that Regulation FD came out, those were real concerns that, this was just add to the cost of disclosure, and companies would probably shy away from sharing the information. So after its implementation, there was research done. 6 years after the implementation, the team of Francis Wand and Nanda didn't find any increase in abnormal share returns. Remember, there were people who had said there would be increased volatility and abnormal share returns between earnings announcement dates. This team of researchers did not find that happening. The regulation had little, but they also concluded that the regulation had little effect in improving the amount or timing of information either. You have lower abnormal returns around analysts' forecast releases. And so the informativeness of analysts also was reduced as a result. So there are people who don't do their own research, but they follow analysts. They follow the advice of analysts. But we found that the advice of analysts also became less informative. So that's mixed evidence right there. Another team of researchers found the positive effect that the bid-ask spread, right? We looked at bid-ask spread. Bid-ask spread is the difference between the price that an interested buyer is willing to offer compared to an interested seller. If the gap is small, narrow, there's a greater likelihood that trades will happen. If the gap is big, then something drastic has to happen before any trading occurs. So a reduced bid-ask spread is a good outcome, right? So that was a positive as far as this research team. But then there was another research team that questioned their findings. Maybe they disagreed with the methodology, or maybe they found that the population that was studied, or the sample size, was possibly not reflective or representative. There were some methodological concerns raised, which led the team of Sidhu et al. To question the overall findings of Eleswarapu. So, conclusions from Regulation FD. You don't need to worry too much about the details. There was a standard that was brought out with the intention of enhancing transparency and access to information. There were concerns raised by certain parties about whether the standard would work. The research on it has been made. That's usually the sad story for a lot of regulatory work, right? You come up with a standard. Did the standard achieve its outcome? You'll always have, depending on, and sometimes, it's just a reflection of the political leanings of the researchers. You tend to get mixed results most of the time. Does improved disclosure reduce cost of capital? Yes, say some people, not really, say others. And that is the sole reason that researchers have their jobs, because they keep studying the same question. All right, so in order for a standard to be successful, what criteria must it have? Well, number one, it must provide information that is useful. And it must reduce the effects of information asymmetry, both moral hazard and adverse selection. Because information asymmetry is the bane of capital markets. If people can't trust the other party, and by people I mean the lenders and creditors, lenders and investors, if they can't trust management, they will rather not want to do business with them. By investors withdrawing and lenders not willing to lend, the scope of economic activity for the companies becomes limited. They can't thrive, they can't achieve their true business potential. So that is a negative outcome for society in general. So we want capital markets and managerial labor markets to thrive and work efficiently. You need to reduce the negative impact of information asymmetry. A successful standard should be able to do that. The standard should impose minimum, if not nil, economic consequences. Every new accounting standard is going to have an accounting effect, right? A change in a standard, like otherwise there's no point to a change if it does not, result in either the expense or revenue to go up, go down, or have an impact on asset values, liability value. And that should make sense, right? When we're talking about a change in accounting standard, the standard change should have an impact on either the income statement or the balance sheet. Now, by affecting the income statement or the balance sheet, there's no effect on the cash flow. Accounting, how you account for something, does not affect the amount of cash received or paid, right? Accounting is separate from the underlying transaction per se. Accounting never affects cash flows. But how we account, if that then has the cascade effect in terms of the consequences that we've looked at in earlier chapters, then that is definitely going to cause concern and pushback from the affected party. So a successful standard should minimize the incidence of economic consequences from the standard. And lastly, you will never get a standard to work unless people agree to it. So there should not be such vociferous and vocal opposition to the standard that people will never say yes to it, right? So you need to build compromise. You need to build, even if you can't get consensus in the end, look at this is the beautiful part. Like you can have a lot of debate and controversy, but as long as more than 50% of the affected parties agree, since we operate on democratic principles, once a standard is adopted, then everyone has to abide by it. The auditors make sure, right? So once a standard is adopted, then everybody, even if people disagreed with it earlier, they will have to abide and comply with. That's the beauty of standards. So four things for the standard to be successful. International integration of capital markets, factors that affect such integration involve number one, are the accounting standards that exist out there converging? Now, in reality, the biggies at this point are US GAAP and IFRS. In terms of sheer number of countries that follow IFRS is by and far the most important. But given the size of the US capital markets and just the fact that it's in the media limelight all the time, the US in terms of world population is very small. If you think about the US population compared to the world's population, the US is about 3.5% of the global population. But in terms of the capital market size, US is about 25%, about a quarter. The US really hits beyond its heft when it comes to capital market size. Yeah. So for a long time, IFRS folks and US GAAP folks were working towards kind of converging, ironing out any differences between the standards. And you need that for ease of flow of capital across the world. That's kind of died, right? So it's no longer happening. And when you have competing standards, there is always going to be a preference of one over the other. The other thing that has an important impact is customs and institutions. So in Europe, they report IFR under using IFRS. So do we in Canada. So do companies in Britain. But if you look at the institutional context, Britain and Canada are more similar because they have the background, the history of the what's called a common law, right? We are common law countries, right? We follow the principles of common law. If you compare, let's say, France, Germany, Spain, those countries have more civil laws. They are code law, like France has the Napoleonic law, civil code. So those countries, the companies that are formed, the rules and laws that they have to follow, those rules and laws are much different from the company, the laws and regulations that companies in the UK or in Canada have to follow. So even if you pick up now companies from, say, if you picked up a company from Canada and you want to compare it to a company from France or Germany, it will be difficult for us to be able to do an apples to apples comparison because the institutional context that they operate in, in Germany, France, the financial statements are prepared more from the point of view of the tax code, right? They have to be compliant with the tax code. The Even though shares are owned by shareholders, in terms of relative power, these countries allow for more power and participation in governance from employee groups, right? Unions and so on. The lenders have big say as well. If you want to compare Japan, now Japan obviously doesn't follow IFRS. I mean, they have their own gap, but you can't really compare a bank in Canada to a bank in Japan. Very, very, very different context. So on an international scale, it was very difficult for investors to be able to, look at companies that operate in a different context and be able to do efficient capital allocations. So usually what ends up happening is investors from North America kind of prefer to stay limited to North America, even though they could have, in theory, invested in companies outside of North America. Just because they don't understand the institutional context, we stay, and you get capital deployed in a localized manner. You don't see the integration across international integration across capital markets. The third thing, of course, is accounting standards. You can have two countries, both of them require IFRS, but one country has a lax regulatory environment. The trustworthiness of reporting from such countries will be lower. And of course, there's a question of benefits that arise from adopting high quality accounting standards. Um, Research has shown that there's more capital that can be attracted from having high quality standards, higher liquidity of the capital markets, lower bid-ask spreads, and so on and so forth. Questions that have not yet been addressed and that reduce or limit international integration include question of which one's better, IFRS or US GAAP? Should we compete? Should we allow these standards to compete? Should the US adopt IFRS? Well, that last question is done. That's not going to happen. Now, if we did have common set of financial standards, it will result in overall lower cost of preparation because theoretically you would have software that could be deployed globally that would help reduce the financial statement preparation. Companies could integrate across transnational borders, their information systems. The generation of the reports would be that much quicker, less reconciliations needed, etc. And overall, people will not have to learn different sets of gaps. So we'll have reduced network externalities. And there is some support for these arguments. But in spite of having worked for several years, the FASB, which is Financial Accounting Standards Board in the US and the International Accounting Standards Board, they've really not been able to converge, and that project of working together is dead. The last standard they came out with effectively was the lease standard. After that, they just decided to go their own separate ways. I've, I've basically talked about common law versus code law, so this is just elaboration there. In code law countries, there's less information asymmetry because the regulations are very explicit about what has to be done, but they tend to have high recognition lag because um, in you due to very rigid laws, companies are not able to recognize certain accounting items in their books. So the quality, overall quality in terms of informativeness is lower for companies that operate in code law countries. Um, we don't have a guarantee that just adopting IFRS is going to somehow be the magic bullet uh, because you have to look at institutional characteristics as well as enforcement. In countries where you have a greater involvement of the government, the state, um, bad news tends to be reported or not reported. It either tends to be reported later or not reported at all, which means what we are saying is there's a recognition lag, a higher recognition lag for bad news. And that is sometimes the criticism levied against, say, investing in China, because of the powerful government, you find you don't get to hear news about Chinese companies until it's too late. Enforcement is a big issue, right? I mean, we can't assume that just because a country has laws, they will actually enforce the laws in a fair manner. Quite often, countries will. Well, India has been a classic case of, the government trying to use strong arm tactics to force companies like um, telephone companies to pay international telephone companies to pay billions of dollars in back taxes and so on. And when taken to the international court of law, the Indian government lost. Right? That's shameful, but you'd see, and recently they were trying to get after BBC just because they came up with a documentary against the Indian leader. Like I don't have a personal view there, but I'm saying these are things which then raise questions about, will we as investors be protected if we put money there? So you have to kind of look at the enforcement, and if their interests will be protected. Auditing is an important enforcement mechanism for sure, and high quality audit is helpful for companies where you have a high ownership concentration of founders. So, typically in countries like India, I believe in Indonesia, Philippines as well, there are companies that are owned by very high profile families. A lot of the shares are owned by the high profile families. And then, there's some chunk that's owned by large volume number of individual investors, but the older family owns a lot amount. So in those cases, very often the businesses are seen as not really separable from the families. Having a high quality audit tends to reduce the agency problem there. Um, you typically see lower ownership concentration in countries that have strong laws that enforce auditor liability. If the auditors are going to be held accountable, then you'll find the auditors will take care to protect the interests of the investor, and you'll typically find less incentive or less of a benefit from there being any concentration of ownership. And we've seen this big four auditors usually have positive effects. All right, so if we adopt high quality accounting standards, market liquidity will be improved, analyst forecasts will be improved, The information content of earnings will be increased. Our earnings quality and comparability will be increased. We will have greater liquidity, lower bid-ask spread, lower cost of capital, all of which are super, super, super things to be aspiring for. Which one's better, IFRS or US GAAP? Well, literally, if we were to look at measures of liquidity and market depth, Lowe's found there was really no difference between countries following IFRS versus countries that followed US GAAP. Interestingly, I don't know if you're aware, the US uses US GAAP, and it is my understanding, I might be mistaken, but there is so also does Iran, and I think Venezuela, which have very excellent working relationships with the US, apparently. Uh, Barth Landsman found that accounting quality is better with US GAAP, but comparability, and there is lack of comparability on average between IFRS and US GAAP. And since much of the capital markets heft lies in the US, often US investors shy away from uh, countries that follow IFRS. They like to see their own GAAP. Should we allow the standard setters to compete? If we can't get them to converge, should we allow there to be a competition? Well, that's not necessarily going to work because one size fits all solutions don't exist. But if we were to anticipate any gains to competition, those gains will arise only when you have low scales of economy and where the regulator um, is clueless, is at an informational disadvantage. So maybe having some bit of competition will work where the rule of the law or regulations are not appropriate. And this particular competition, the effects of standard setters competing was discussed by Dai and Sundar. And they figured that there's two possible outcomes. When two standards start competing, you might end up with a race to the bottom where you basically get the lowest common denominator. Or in theory, you could end up with a race to the top where you can see the best possible standard emerging. In reality, you're not really going to get either. And you will never really end up with a socially optimal amount or a correct way of deciding how much or which standard should be followed in terms of information production. So maybe the US should adopt IFRS. That's supported, or for a while it was supported by the Securities and Exchange Commission. All right. So for example, stateside, if companies follow IFRS, they don't have to reconcile IFRS numbers to US GAAP. That was one of the reasons why Canada moved to adopting IFRS. There was talk in Canada about us adopting US GAAP, right? US folks would have been happy if Canada adopted US GAAP because they feel that US GAAP is better than IFRS. It's a pipe dream, right? It's all in imagination. It's not really going to happen. I don't see the US adopting IFRS. And now that Canada is wedded to IFRS, I don't really see us dropping IFRS and going and adopting US GAAP. We're going to be living with, hopefully, we will no longer have ASPE at some point, right? We'll all be doing IFRS. But again, hey, who knows? If we could get standards to converge, then definitely for multinational companies, it will be lower costs and there will be greater flexibility to prepare us. But there would be costs in terms of transitioning, audit fees will go up. There might be some friction arising from transaction costs. Investors might need to familiarize themselves. If, let's say, US move to IFRS, the good people of the US accounting fraternity and the industry will have to learn IFRS. And then there's always lawsuits, right? People should be, if someone felt that they were unfairly treated or cheated, there will be lawsuits. So, what was the sum of this chapter? Standard setting is a noble enterprise, and yes, it is a response to markets not working. In principle, standard setters should be trying to achieve the get the best standards possible. But in reality, there's a lot of political interference. Just as we see for laws in general, in the state side, you have lobbyists. You know, for every U.S. senator, you have, I don't know, so many lobbyists. Apparently, it's a big industry, and they get money, and they get money to stall things, to create so confusion. We saw the tobacco lobby push back, climate change, again, those kinds of things. There's a whole sort of thing. The science is not settled. That's typically the thing. So in accounting standard setting world, you would argue again, we need to do more research. That would be the lobbyist's best dream, right? You don't like a new standard coming up. Oh, we need to get more research done. And companies often have deep enough pockets to keep, shelling out some money for researchers to go do some research, and then they'll come back with research findings that typically tend to conform with the sponsoring company's point of view, right? So that's why you get these, oh, one set of researchers found X, the other set found Y, and the debate continues. It's an ugly process, right? You try to achieve harmony, you try to achieve consensus. And if you think personally, why should it matter? You're a student right now, but you will become an accounting professional, and you will then be applying these accounting standards. I don't know how many of you have ever asked why. If you've learned in your courses, in your financial reporting courses, how we should be accounting for inventory, how we should be accounting for investments, how we should account for PP&E, this, that, yada, yada. But we rarely talk about why. Who decided that goodwill should not be amortized? There was a time when goodwill used to be amortized. Who suddenly decided that was not a good idea? And sadly, for the most part, in classes, I myself am to blame. At times, I avoid that why part. I just teach this is how, this is how, this is what you do, this is how you do it. But without the why, if there are choices available, if I don't understand the why, why did we even have a bloody choice in the first place? And what would enable us to make the right choices and so on without questioning? And I've had the sad experience as a student of sometimes asking, why is it this way? And the instructor would reply, don't ask me that. That's what the standard is. But now you see how these standards are made. When the standard was, there's a lot of politics, there's a lot of lobbying, and we just sometimes get an outcome where the strongest lobby wins, which does not necessarily mean that we got the best possible standard. But once the standard is adopted, then it becomes the law, right? I mean, everybody has to follow it. The auditors are going to insist that you do it this way, right? It's troubling at times to kind of think, if we don't understand the process, then we will become possibly at some point in time willing victims of that flawed process, right? So anytime a new standard is set, there is a process of inviting comments. If you work for a company and you strongly feel for or against something, the last thing you want to be is apathetic, indifferent, right? And I know I'm sounding a bit preachy. It's that time, but this is our last class. So my parting message to you is, if there's anything you've taken out, is that at the end of the day, you've chosen to accept and embrace accounting as your career, as your vocation, right? You will spend many years of your life in this field. So it is important to be curious, inquisitive about what your position is in this world, how you can make a difference, how you might be impacted by forces that may at times seem outside beyond your control, right? And if there's ever a way that you could participate, you should. This is one way. If there is a new standard in the offing, knowing about it. Many a times, you will get information from CPA, you will get, but often we don't even pay attention. Those emails go to our junk folder right away. If you remain unaware, well, the only time you will learn is, oh, there's a new law now, there's a new standard. Everybody has to comply. Oh, when did that happen? Oh, geez, I must not have been. I was very busy. All right. So, anyways, that was my message. It's 8:50. I better shut up. I spent a little bit longer. Anybody have any points of reflection to share? Any comments? We will be seeing each other in person one more time in 2 weeks' time, but that would be hopefully and I didn't want to sound very, I'm not depressed or anything. I have hope for accounting. I've embraced accounting. I love teaching accounting. Fairly competent on the technical side as well, but I think the theory is often missed, right? We don't look at the why, the hows and whats seem very alien. It isn't as if God revealed these truths to us, created by us humans. That's all I had, my friends. That's all I have to add.
Thank you so much.
Well, thank you, Talita.
Parting words really powerful. Appreciate it.
Well, I don't want to sound preachy, but I do strongly feel that not knowing, like, I'm not a rote memorizer, right? So when I learn, I want to understand why I'm doing things the way I'm doing so that then I can, if I understand that, then maybe I can come up with a better way of doing it. But if I don't understand the why, when I teach advanced accounting or intermediate accounting, if I don't get the underlying principle as to why are we doing this? What's the point? Then it's hard for the brain to remember it in the longer run. Like, you memorize in the short run and then you write your exam and you forget about it. But if you can understand the why, then maybe it will hold. And possibly, the way I'm explaining the what, then, if you understand the why, then the process that the instructor is going through, maybe you as a student can find out an easier way to work around it, right? So those epiphanies are possible only when you have a better understanding. And theory can be very dry, can be very boring, and sometimes it's presented in a boring manner. I know I am guilty of that. In some of the chapters, I've been very, very, very boring, right? I could have done it more anecdotally, etc., but I had to there kind of follow what the syllabus required. But many a times the story is very simple. For a class that took 2 hours, 2.5 hours, sometimes the story can be told in 15 minutes. This is the gist, the rest is just commentary, right? So try to see that in in whatever sort of endeavors you are exposed to. If you are able to get the why, you will be able to get the how and the what very, very, very straightforward.
Yeah, thank you.
Right. Thank you for that comment there. And I'm seeing folks are logging out. I guess I should stop this recording first.